But another really good thing to know about this is, if you think about it, this is on December 2nd, and this is only in 2 weeks, which is pretty fast. And 2 weeks pass by pretty quick. In 2 weeks, you know, if the price can go up, right? But if we're in a downtrend, the price is not going to go up for such a while, logically, because we're in a downtrend. It's going to be this rally, but it's not going to go up as much. So if I have that aware and I do it for 2 weeks and my strike price is far away, there's a less probability for the price to hit the strike. And what I do is, obviously I don't let it hit the strike. As soon as I get it, as soon as I see it get close to the strike, I just I sell if I'm losing 50% of the premium already, which likely you are. I I do that. But the great thing about selling a call is that if you're in a downtrend, if the price did go up, but it didn't go up as much, it went up to just $6 and it stayed there, which is really realistically in a rally. If it went up by $6 and you did this by resistance, right? You did this by resistance and the price went up, but it was like sort of lagging. It had trouble because it was fighting against the bears. And it took about a week and a half, and maybe in a week and a half, it went to the strike. If it did that in a week and a half, that would be on, if I click on this calendar, that would be in a week and a half. So that would be, really this would be in half. Let's say the 25th of November. I would be losing 188, right? I would break even. But let's say on the 29th, you can see I'm still losing $69. But if the price went up to 118, it's not at the strike, but 118, it topped and went down all the way to 115, I'm making $76. If you look at the box on the bottom left, I'm making $78. And it stays there for 2 days, and then it goes down to 112 or 111. Well, now I'm making about really max of what the premium is now by this time. Or if it just stayed, let's say if it stayed at 115, making $115. Over here, $96. So this is the thing that I like about selling, that you don't need to be exactly correct on the price. The price could go up a little, it could go down, it could stay at the same price, but as long as it stays within that area for a period of time until the expiration comes, you will collect the whole premium and you will win the trade with a profit. Now, of course, I'll explain this in the strategies as itself, because I'm just teaching you guys the basics, as the basics is very important to understand the game within these strategies. But right now, I wanted to show you that. So now let's talk about let's talk about selling puts then. Let's talk about selling puts. So for puts, actually, that's why I kind of labeled it like green selling and then red for puts. In total, you're actually going long if you're selling puts, and you will know why. When you're the seller of a put, you get to collect the premium right up front, just as if you were selling a call too. You're going to be collecting the credit. You will be paid for entering the trade. Of course, when you enter with a credit, you will see that the net liquidity will be higher from the trade, like if you're already winning, but in reality, you're not winning yet. You're just waiting for the premium to go down. So if you sold a put strike at $7 below the spot price of $90 for an expiration of 20 days, and it's been 8 days and the price went up to $6, that put option will now be worthless, despite there being a little bit theta left, because the premium went up so much that the extrinsic value wasn't enough to offset it. And especially usually when strike price is farther out of the money, it has less extrinsic. Oh no, it has the same sort of extrinsic, but it's just hard for the price to go up. That's why they're whenever they're strikes. So that's why you see out of the money calls be cheaper, because they're less likely to be in the money within the expiration. That's what you see when it gets closer and gets more expensive, because it's just the probability for it being in the money. So because of this, when it expires worthless, that's great because you get to buy back lower. If the option that you sold costed $165 and now it costs $6, nets you made a profit of $159 in credits, almost the whole premium. So you benefit doing this as you're selling. You benefit when the premium loses its value as the seller. of the puts. So, like selling calls, you will benefit when the premium goes down, and that means that you benefit as well when there is time decay. It's the same thing. Again, time decay will decay by every day. The theta will lose in value. So, because when you buy an option, it loses its value as it gets closer to the expiration date extrinsically, if it's out of the money. This is called being net short on theta when you sell puts. You benefit when theta decays because you get to buy it back lower than you sold it because there's not much extrinsic value. As a seller, you're always going to be the counterparty of the buyer. And it's the same thing as a call, like selling a call. You're betting against the person who's buying. So if you're selling a put, you're betting against a person who thinks the market will go down or the stock will go down. Because when you're selling a put, you actually are bullish. You're thinking the price will go up. That's why you put a sell of a put, because you think that the price will not go down to that level. It might go up or it might stay the same or it might go down, but not to that level. So as the seller, you're always going to be the counterparty, and the best way how you can sell puts is when the volatility is high, and that shows that they're expensive in contracts, and that the stock is in an uptrend. Because in uptrends, the price goes up more than when it goes down, because it's net bullish in movement than bearish. You should always sell when there is a correction, when it's hitting a strong support, which makes it less likely to continue downward. That's how I utilize selling puts. Now, what's a put seller? A seller of a put has the obligation, not the right, but the obligation to buy 100 shares at the predefined price if it expires to the buyer. So remember, as I said, that the buyer of a put has the right to sell 100 shares. Now, who's he going to sell it to? Well, in this case, it sounds funny. The seller will receive that sale of 100 shares, and he will buy it at the price. So you guys can understand now, like, the relationship, the buying of the price of the strike. So because the seller has the obligation. If you're selling a put and it expires, you are obligated no matter what to long 100 shares, even if you don't have the money. And again, this is called selling naked. I don't sell naked. I never will. I always have a different strategy to offset each other and net close both of those positions if I don't want to hold 100 shares. As a seller in its nature, you should always be careful, because when you're selling an option, there's a possibility for the price to go down. As we know, an option can go down in value infinitely in put options, which is risky and only lose limited, which is a premium. But there is a trick over this, just as selling the call, which you guys will understand in the when I explain this in a big depth with the strategies and the scenarios. So when you're the seller of a put at expiration, you are the buyer in the shares for that buyer if the buyer decides to assign for you to short 100 shares before the expiration. I know that sounded funny, but that's really like what goes on. Now again, this never really happens, because like buying a call, you have a right to exercise. So if you exercise early, you will always be paying a net debit for trade, since you lost the premium of the option, and the seller wins the premium, but he's assigned, or that person's assigned 100 shares, which are assigned to short 100 shares, which rarely happens. In calls, as I said, a part motivating reason for a person to exercise early is the dividend schedule payout date. If it's tomorrow, so they will want to quickly hold the shares in order to receive the payout. But these are puts, though. You as the buyer, you have to sell those shares. So it makes absolutely no sense for a put buyer to assign his contract early if it was for dividend date, because he wouldn't even collect the dividend date because he doesn't have the shares anymore. So you see how that doesn't make any sense? It's actually less likely for a put to be assigned rather than a call to be assigned because of that. Now let's talk about the P&L graph of selling a put. This is Adobe. And if you see here, I chose a strike price of $315. It's a put, and I'm shorting it because it's -1. And I chose an expiration date of December 9th. You would see that the premium in total is $510. And the current spot price is $330.86. I chose this to be like if I was buying at November 18, and it expires in December 9th, which is 21 days. Now let's see how that looks like. Okay, so this is how the option looks like. If you guys look at this, it's the exact same as the call, only the opposite. So instead of, in the call, when the price goes down, you make a profit. In this case, because you're looking for the price to go up when you're shorting a put, you're actually looking to make money if the price goes up, stays the same, or goes down, but as long as it doesn't go down to your strike price. It's the exact same thing as selling a call. It's the exact same thing with theta. Like I told you, if whenever the prices are closest to the strike in this area, the theta will always be bigger because that's where the extrinsic value is the highest, and when it's the highest, it means that it could be an enormous amount of devaluation if it stays there until tomorrow. That's actually very important for you to understand. And that's important to understand when you need to secure profits, to have that in mind that, hell, if I keep my option here, I should sell it because, if I bought the option, I'm going to be guaranteed to lose tomorrow if it stays there at $43 of a loss. But for me as a seller, it's somewhat good, even though, it's like sort of pain over here, but it's not at strike, but it's sort of pain because you can see that you're losing maybe like $200 or something. But in reality, you're not losing yet because, as time goes on, if you look at this price, what's 315? It's right here. Okay, it's right here. It's $46. As you see, as time goes on, $49, $54. By oh wait, I didn't even look at this like this. No, this date is like that. I was accidentally looking at another date. So if you look at this, my bad guys, but if you look at this, 315, yeah, like right here, 300 and what is this? $315. You're making $28. You're guaranteed to make $28 if the price stays here today. Look at tomorrow, $28. That's already $56. $85. Well, it goes on 90, 100. That's already $105. 105. That's already $136. That's already $168. So you see, like, you've already realized maybe like 30% of what this has been, and it's not even been. It's only been a week. You have about 3 weeks. Let's look at December 2nd. Well, now, like, I think you've made maybe 50% or more of your entire contract if it stayed there. As time goes on, you see that by December 7th, if the price stayed there, you're actually making money now, which shows that the person who had their money there and didn't sell for the buyer is actually losing $64 of their contract when they were making a ton of money. So that's important to understand. But you can see that it's the exact same thing as I told you. In this case, remember that when you sell a put, you want to do it in an uptrend. Why? Because if you do it in a downtrend, you don't know if the price can go down more because it's in a downtrend. You don't want to short puts because the price can go down. And what if it goes below your strike price? Well, you have an infinite loss. If it went to $310 to $300, you're already losing $1,000. That's twice of what you were losing initially. You don't want that to happen. In an uptrend, this rarely happens. Sometimes it can happen, but before it even starts to happen, before even that, when I see it gets close to the strike, like when I see it to get close to the strike already, I'm selling. Why? Because if I get it to get to the break even, I'm already losing more money. If it gets even close to the strike, I'm already like closing the position because I'm not risking my capital. Because there's always probabilities that the trades can go against me. But the great thing is that if the price goes down a little, if it goes sideways, if it goes up, no matter where it goes, throughout time, I'm going to make $510. So those are puts. Let's talk about the pros and cons of selling calls, just like the pros and cons of buying them. So when selling them, the pro about it is that unlike just going long on a single call, where you need the price to go up sharply before an expiration date, when you sell, since you benefit as time decays, your premium will start to realize itself, which is starting to gaining profit and like realize the profit in itself as long as the price doesn't go above your strike price at any time. The other great thing is the price can go up sideways as long as it wants, but you will still make money when time passes on because if the spot price doesn't pass the strike price, the option again doesn't have intrinsic value but only extrinsic, and extrinsic gets killed always as time goes on and eventually doesn't exist at expiration. So therefore you still win if the price went against your trade because extrinsic dies it dies even. Remember what I showed you? When the spot price is even close to the extrinsic value to the expiration to the strike price, that's where extrinsic value dies the most. That's when there's more extrinsic value, which means there's extrinsic value to be lost more as time goes on. That's very important to understand. I know that sounds very technical, but it's the way how it is. What's the con about it? Um, well, the con is the risky part is if you don't use them responsibly, you have an unlimited risk because the price can go as high as it wants as you will have to buy it back more higher than what you sold it for, which isn't good for a seller. Another thing is you are always capped at a profit area when you sell, but are vulnerable when the price goes really against your head trade. And head trade means the direction of the trade that you had, because a buyer you has infinite gain if the price goes to your direction, goes to his direction or her direction, and they have limited risk. Their limited risk is your gain. Their infinite gain is your infinite loss. But however, I know that sounds very like I'm not going to even sell then. Yes, but however, I wouldn't do this if I just let the price does do whatever the hell it wants. No, I recommend doing this if you're active. If you can manage the price well. Why? Because if there's a certain way how I utilize options that have a high probability within the statistics, I choose high probabilities. And if I see the price is very unlikely technically, statistically, and within the option for it to hit that price, that means that I have a high probability that wherever the price goes down or up, that price won't hit the strike and I will make money. And if the price even gets close to the strike, I'm already like exiting the trade. So that's why I like that, because remember the way how I trade more than 50% probability. So 60% of the times, or 65% of the time, or even best case scenario 70% of the times, if 65% of the times the price reverses and you make a profit, that means that within options though, within the option statistics, I usually choose things that have like about a 75% probability. So put that to be even a 70% probability. And if 30% of the times the price doesn't go to your direction, I'm already like cutting lost very fast and I'm not losing as much. So that's why I would use selling calls, but I don't just sell a call because that's called selling naked. I don't just sell a call if I don't have the cash. Now, when you have the cash, which I'll talk about that strategy, those are called covered calls. You are always capped at a profit area too when you don't. So that I explain that, and you might end up losing more than what you thought if you don't honor the trade, which I don't do. I do honor the trade, and again, like if you're buying in options, you always have to pay commissions and fees. Now let's talk about the pros and cons of selling a put. It's the exact same as a call. Like selling the calls, you have data working in your favor. The more time passes, the more money you will make. The stock can literally stay still. You make money. The price can go down. You make money as a put. Selling puts. You will make a profit on all scenarios as long as the spot price isn't below the strike price in this case, because by expiration there's going to be, remember, intrinsic value. You will end up losing probably more than what you sold the option for, which you don't want. And of course, I made that. I never let that happen because I don't. I sell as soon as it gets close to strike price. So I never let that happen. I never let the option have intrinsic value now, because I always sell it before it hits the strike. So the con about this though is similar to selling calls. You have infinite risk and limited gain, and you have to pay fees and commissions. But again, this isn't. It's a con, sure, but I don't let this be much of a disadvantage because I always sell before even if it goes down to that level. So by now, it's very cool because you guys have now a very basic play now of an option. What you guys learn now is something that there's a lot of people that you can tell, like, there's some people in options that have 2-3 years of experience and they don't know anything what I just told you. They don't know all that technical stuff of theta and how it works, because it's really, and like, can you imagine how they do options then? It's unrealistic. Like, that they don't understand how theta works, they don't understand the volatility, they don't understand intrinsically. What the hell are they doing? Like, that's actually risky. That's way riskier than not understanding that, because when you don't understand the basic play, how the hell do you expect to make money in options if you don't even understand the value worth of what the option can do when the stock prices go up? So that's why people complain that when the stock goes up, their option decreases in value, and they don't understand why. They just think like, oh no, just that's the way how options are, and you need the price to go up in a shorter period of time, but they don't understand time value, how it works into your favor. But you guys do. So with learning buying calls and puts and selling them, this will give you a bigger perspective and literacy when you look at the option strategies you encounter in this course and all other that exists, because you're going to understand, you will understand the mechanic in the strategy, which is crucial in options. With knowing the mechanic, you can know what to expect from the option itself. Now, I'm glad to have shown you the basic fundamentals right now. But at first, I've showed you by now all the basic plays you can do in options. It's very similar like learning basketball rules, where you learn the rules, you learn what areas to shoot, you learn how to shoot the ball in the basket. But this is just a scratch on the surface on the different plays and different tactics you can play around in the most convoluted or opportunistic scenarios in the market, and how to out trick them and benefit from them. And that's what you guys will learn in this course. By now, you have learned the fundamental basic for your option journey. Right now, you have learned the kindergarten level in options, but in this option course, you are literally, and you guys will see, you will literally go through first grade, second grade, third grade, fourth grade, fifth grade, which is elementary, then sixth grade, seventh grade, eighth grade of middle school, ninth grade, 10th grade, 11th grade, 12th grade of high school, and then college and university of options. Like, I'm not kidding that. I'm not over exaggerating that. You guys will learn every single step. And but in this time, what you will learn will actually be completely applicable to what you do from your real knowledge and experience, into which in this case is the option world and your portfolio. Unlike, of course, if you go to school and you get a formal education, it's good if you're a doctor or sort of within the law that's needed. But if you're going to be an entrepreneur, or if you're going to learn about the stock market, or you're going to learn about some sort of tech, which you can do, but they're optional. You're better off in business learning through people who have results in their master plan and what they've done. In this case, I know a lot. Trust me, I started in the stock market within options, and what you guys will learn here is literally going to be from kindergarten all the way to university. You guys will understand completely every cranny and crack and cranny on every option deal. So, this is all these strategies. It's a lot. These are all these strategies that you guys are going to be receiving in this course, in this option course that you guys have. So as you see here, there's many strategies, many strategies. There's about 3 strategies that you can use in a lateral trend. One is calendar spreads, iron condors, and butterfly spreads. Those can be used in lateral trends when there's same highs and same lows, or in consolidation trends, or forming a neutral trend. Now, in very bullish trends, where you see that the price is going up and down, it's a complete uptrend, and the moving averages are showing that it's an uptrend. You're going to be buying single calls. You're going to use net long vertical spreads, stick up vertical spreads, covered calls, seated calls, cash secured puts, umbrella up, and diagonal spreads. These are all the different sort of sometimes mix and match within somewhat bullish, but most of all, I use these strategies within very bullish trends. Now, in very bearish trends, I use single puts, net short vertical spreads, cash secured puts, short butterfly spreads, mutated bearfly, short back ratio, umbrella down, coated vertical spread. And when you're in a somewhat bullish, which means like if you're not sure, or you're not as bullish, you don't think the price is going to go up significantly, but you do think the price will go up and not significantly, you can use the long back ratio, the seated covered call, long diagonal spread, the seated calls, long butterfly spread, the transformed bullfly, the cash secured puts, and umbrella up. And finally, with stock or earnings, you'll be learning earnings flat spread, earnings kick spread, and RI to E.S. I've saw in total there's about 26 strategies. This is why I'm not kidding. You're literally going from kindergarten all the way to college and university, and this shit literally you do use. Okay, you do use for many different scenarios. I'm not kidding. Many scenarios. You can be using this all the way from swing trading to somewhat day trading, which some of these I use within the day trading pattern, which is what I will talk about within the RTI too. There's a lot of abundant material that's going to be covered in this course, and I can't wait because there's so much being poured down that you guys are going to have a lot in your arsenal to get through. And this took me, there's a lot of value throughout here that I've learned from what I've seen and throughout price action. But these are really all the strategies, because there's so many different others. In fact, I actually missed one. Yeah, my bad. I actually missed one. I don't know why, but there's actually, you know, there's actually, that's what I was gonna say. Like I felt like there was one missing. So in this, you can go. There's also long synthetic, and there's a collar synthetic, and in here there's a short synthetic. All right, you could say now that there's actually 28 strategies. That's what I was gonna say. Like I was like, wait, there must be like I felt like there was one missing, and there actually was. So there's actually two. So you will actually learn in very bullish trends the long synthetic, the short synthetic, and very bearish, and in the somewhat bullish trends, you guys will have the collar synthetic. So there's in total 28 strategies. All of them can be used in many different scenarios and in many different styles. And it's an enormous arsenal, but it's all, you know, there's a few strategies and options that I don't do, but all the ones that I showed you here are the best ones that I've seen and done, and give out the most predictable and sort of positive expectancy that you can have in options within any trend. So in the next video, guys, we'll talk about the option chain. It's very important for you to understand that because it's what makes your analysis in the option accurate. And, you know, I want to let you know that everything interplays with what you have here with each other, with all types of trading in the options using different strategies here. And I'm very sure of that. Like there's so many like different strategies within here that you will use within the some part of the option within risk management, another with the other risk management. It all interplays into each other with what you can do, and you become so flexible and so knowledgeable into what you could use with what different strategy depending on the different market scenario. And it just really is it's amazing. So once you find the pattern, though, the thing is within options, once you find the pattern of law in options, everything then becomes a bit easier. What's that pattern of law? Is that basic play, the basic fundamentals, and the differency of what you can see in your mind mentally, how things interplay with each other. You will find the pattern of law. Definitely. And you guys will understand after you learn a lot of what I've been telling you. And if you had a bit of experience, you will see things a bit easier within options. And you will see that within your experience, you're going to have way higher highs and higher lows completely. So that's it for this video. In the next video, we're going to talk about option chains. Hope you guys have a good day, or see the next video.